This is a Brooklyn-bound 2 train. The next stop is
Wall Street.
Stand clear of the closing doors, please.
Welcome back, everyone. This is Not Your Advisor with NYU Grad on Thursday, July 25th. Let's go right into the session. I have a lot to cover today. So let's, before starting with breadth, I wanted to thank Bill Cara, who sent me and posted publicly a very nice testimonial, which I'm just going to quote. I'll share it, and I'm going to add it to my testimonials page, but it means a lot coming from someone of his caliber who's been in the markets for over 40 years professionally. So it means the world to me. He wrote on his website, quote, "I would like to remind people that there are excellent ideas to be had daily at NYU Grad Substack. The challenges that exist in financial markets today are possibly greater than ever in my 40 plus years of professional experience and almost 20 more years as a private investor. The amount of so-called investment and trading advice offered today is overwhelming, but the majority is unhelpful and probably promotional content you must avoid." So for him to contrast what is out there, and I know you have a lot of options, and then to kind of contrast to the quality of my work means the world to me, because this man has been a mentor of mine, and I slowly learn. And I know some of you are just starting to pick some of my content up and starting to understand it. And then some of you are a little bit more frustrated and want to be more directed. It doesn't come overnight. It takes a long time, but hopefully with sharing what I've learned, and I don't know everything, there's many ways to cut the cake or bake the cake. But I'm hoping with sharing with what I've learned, it will accelerate your learning curve if you're new to even watching the markets and trying to get a grasp and control of your financial future versus just letting someone else direct it and suffering the consequences. Because ultimately, even if you don't want to manage your own wealth and grow that, you have to at least know enough to grade your financial advisor's work. Because if they lose your money, you have no one to blame but yourself. You can't really blame them because it was your decision. You vetted them, you interviewed them, you compared to other advisors and firms, and you ultimately chose them. And I've heard stories where people have gone from one advisor to another, and they're like on their fifth advisor. Ultimately, the buck stops with you. It's your money. So I want to thank Bill for that testimonial. It means the world to me. I'll share that in the show notes. And the other thing I wanted to point out was I know there's a lot of talk right now about Fed rate cuts in the news, in the Twitterverse or Xverse, as well as Substack, and just on the news itself. I just want to remind you all, in history, doesn't mean it's going to be this way again, but in history, multiple times, when the Fed pivots, that is the signal that the bull market is over. Sure, the first week, the first couple weeks, maybe the first month, they announce maybe a 1-point rate cut when they were only expecting to do 0.25%. Maybe we'll rally off of like the hopium and, wow, we finally got the rate cut, and we'll rally a little bit. But over the course of 12 to 20 months, the market has gone down a lot after that decision. So I'm going to post the data going from the Great Financial Crisis, the dot-com bubble, the Gulf War, the double dip recession, the 70s, and the month and year that the Fed pivoted, and the negative move that the markets have done, and how many months it took for that move to happen. as well as the Fed pivoting and unemployment spiking. So typically they will cut when shit is about to hit the fan. Excuse my language. In the 70s, with the Fed rate cut, the market, the S&P 500, dropped 45% peak to trough. So that's something that I wanted to point out to everyone today as a quick reminder. So let's get into today's session. So the breadth numbers were sneaky. What I mean by that is they were bullish. But when you take a look at all of the other data, it was bearish. So for new highs, we had 443 versus 180 new lows. On the NASDAQ, we had 108 new highs versus 42 lows. 62% of stocks were advancing versus 35% declining. 42% of stocks were below the 50-day, and 32% were below the 200-day moving average. What really stuck out to me was we limped into the close. We had every chance to rally today. Vol D and the breadth of NASDAQ were starting to go higher. If you take a look at kind of what the Dow looked like today, we got all the way up to 40,400, and then we closed at 39,935. So we lost 400 Dow points intraday. And we closed right near the lows of the day and right near yesterday's close. That's not good complexion. The NASDAQ opened lower, fought back hard to get above the previous close, and then we limped into the close at the low. Almost a low. Very similar picture on the S&P. We opened down, we fought back to get higher than yesterday's close, and we lost basically 80 points on the S&P 500 in the afternoon. The Russell led the way. I suspect it's going to be a lot of stocks that are heavily shorted bouncing the most. So on a day after we had a bloodbath on Wednesday, you had every opportunity to bounce. And the bulls dropped the ball. Take a look at this on the Mag 7. Microsoft down 2.45% today after being down yesterday. Nvidia down again. Red 1.7%, Apple down almost 0.5%, Alphabet down 3%, Meta down 1.7%, Amazon down 0.5%. Tesla was the only Mag 7 green. It was up 1.9%, but keep in mind yesterday it was down 12%. So it's 5 steps back and 1 step forward. Yesterday, Tesla were on fire, catching fire, exploding. And today, they were doing the Cybertruck march. And by the way, I'm going to post a picture of a Cybertruck that I saw near Manhattan. It's probably the only one that I've seen in Manhattan since they launched. It was a very perplexing day, I think, for both bulls and bears. But if you look at it in the context of yesterday's sell-off on Wednesday, this was a bearish day because every opportunity to bounce was there. GDP numbers came out. And then tomorrow you have the PCE on Friday morning, which Jerome Powell tracks very closely, apparently, for all of his rate decisions. So just keep that in mind. Tomorrow on Friday, you're going to hear a ton of news about the PCE, the Fed, rate cuts. But just know once the rate cut news is absorbed, it's usually historically, so far every time, been bearish and the signaling that the doo-doo is hitting the fan and we are already in recession. It's already too late and the Fed is panicking by cutting rates, especially in this environment with inflation raging, which they lie about. So that's how bad it is that they have to lie about inflation and keep jawboning us for multiple years about rate cuts. And when they raise from, 2% to 4%, they say, oh, we're fighting inflation. Yes, the rate of increase was unprecedented from basically zero, but it's nowhere near where it needs to be to fight true inflation. And that might be what's going on with the whole silver and Bitcoin overnight. I didn't even post about it, but I saw silver and precious metals were kind of cracking to the downside in the overnight session. There was really no news. And Alioisha, who writes metals, oil, and everything else, noted in my private chat that it was potentially has to do with the yen carry trade, which ultimately is manipulation. So we shall see. And for those that don't know, the simple term for yen carry trade is you crush the yen, you short it, you borrow it, you sell it, and you crush it, and you're making money while that thing is going down. And then you're taking all of those proceeds of borrowing the yen and going long Apple, Tesla, Google, Mag 7, all that crap. So that's the yen carry trade. And everyone's doing it, not just the U.S. It's all global banks. So let me go through what was strong today. It's a short list, to be quite honest with you. K-Hovanian was up 7.4%. MongoDB was up 4.7%. Short semiconductors, SOX-S was up 6.7%, Yext 4.5%, PJT Partners 4%, AbbVie was up 3.3%. They reported earnings this morning and was positive. Roku was up 3.3%. What was weak? This list is long. I'm not going to go through all of them, but I'll kind of rapid fire. These are all percents. You had Hut down 17.9%, TeraWulf 11%, IREN 7.5%, Pan American Silver 5.7%, Coinbase 5.5%, ARM Holdings 5.4%, Riot 5.2%, Harmony Gold 5.1%, Silver Futures 4.7%, AMD down 4.3%, Dell 4.04%, Barrick Gold down 4%, MicroStrategies down 3.9%, SLV down 3.8%, Kinross Gold 3.5%, Crocs 3.2%, ACMR Research 3.2%, AppLovin 3.1%, Qualcomm 3.1%, Google 3.1%, GDXJ 3%, New York Community Bank 3%, Airbnb 2.9%, and I'll leave the rest for you all to see in the show notes. Tomorrow's Friday. The PC numbers is going to be the biggest show in town. That comes out 8:30 New York time. Continue to watch the Mag 7, the Semiconductor Index, yields, and free members. Just as a reminder, if you would like to get a discount on the premium membership, just email me at nyugrad@protonmail.com and I'll send you a promo. And I will see you all after the Friday session. For paying subscribers, please stay on. I want to go through the best defended list and the forest versus the trees with you today. That's my train.
Stand clear of the closing doors, please.